Bloomberg Audio Studios.
Podcasts, radio, news.
Welcome to Bloomberg UK Politics, your bite-sized guide to the corridors of power. I'm Lizzy Burden.
And I'm Stephen Carroll. 31 days to go until polling day. We have the dates now for the TV election debates. Lizzy, that's something to be excited about, but I get the impression you're not that excited about what we've heard from the parties so far.
Well, I will be excited when we get some manifestos. I've been waiting for the detail because at the moment it doesn't look to me like there's that much difference between the two parties' economic offerings, and yet Labour wants this to be an economic election and they want to be the change party, but I don't see a lot of economic change coming.
Look, it's this question of how do you solve an advantage of a 20-point lead in the polls? Because, you know, when you're in that sort of position, you don't want to take any risks. And yet, one of the complaints that we hear, and we see it in polling as well, is that people aren't terribly inspired by Keir Starmer. I mean, they don't have particularly good things to say about Rishi Sunak either. But this is, you know, a question of how bold could you be? Are you squandering an advantage when you have that sort of poll lead to not make a big statement? Or is what the voter wants responsibility? Is that the trade-off? Responsibleness versus being inspiring?
Well, also versus winning the election. And you've got
key element there.
The Mung vase theory, which of course is a reference to the 1997 election, this idea of carrying a Ming vase across a slippery floor and you don't want to drop it. It's a precious poll lead that they've got, and they're not being bolder for fear that the public sees them as fiscally irresponsible. They're so fiscally constrained in the post-Truss era that they're not promising, for example, to raise any of the main levers of tax, which would allow them to be bolder in their spending plans.
And it's interesting because if you look at what the Conservatives are planning, perhaps they're the ones who are announcing plans that are a bit bolder. Now, again, the risk calculation very different when you're so far behind in the polls. But things like, you know, the phasing out of national insurance announced before the election was called, of course, the National Service Programme, this idea of triple opt plus on pensions, don't necessarily measure up to things like VAT on private school fees or, you know, scrapping the non-dom exception. They just don't seem to have, they seem to be aimed at a very different kind of audience.
Yeah, and it seems to be about winning votes rather than growing the economy, which both parties claim they want to do. And look, the Labour Party has this huge poll lead. This is the opportunity, as other commentators have said, to get a mandate for bolder policy to grow the economy. And the Institute for Fiscal Studies has said it themselves. You cannot just hope and pray that the economy grows.
Well, look, no matter who wins the election, they're going to have to deal with the financial situation they find themselves in a government. So let's dig into, or perhaps climb up might be a better analogy, the UK's debt mountain with our senior economics reporter, Philip Aldrick. For more on this. Phil, look, the national debt seems to come up in every election campaign sooner or later. The numbers are mind-boggling in extraction, but what sort of sums are we talking about?
So since 2019, the debt levels of share of GDP, which is how economists like to measure it, because it
doesn't really matter how many zeros, to be honest.
It depends how many zeros there are in the GDP, because it's got to be sort of relative to what we can afford. And so that it has risen from 76% to 92% of GDP. So that's a big increase over the space of what has been 4 or 5 years. And if you're talking about pound numbers, this is adjusted for inflation. The debt has risen by about £600 billion since 2019. So we're talking big numbers. So that's it. 400 billion of that is, you can specifically relate to COVID and cost of living crisis support schemes.
I'm just going to be honest. When we start talking about billions and trillions, it kind of goes beyond my comprehension. The yardstick for me is that they spent 70 billion on furlough. I tend to think of that as a measurement for whether something is a big amount of money. And then if you try and compare it with other European economies, that's another way that I can get my head around this, Phil. So we had France over the weekend downgraded by S&P. Not good news for Emmanuel Macron, who's also trying to fight an election on his economic record. When we compare the UK to France, for example, or other major European economies, are we really worse off than anyone else?
So on a debt to GDP basis, no, our debt position is better than all G7 economies other than Germany and Canada. So France has got about just over 100% of debt to GDP on an IMF basis. So there's so many different ways of cutting this, but so IMF is good for international comparisons. We've got about 92% on this IMF base. So they've got a lot more debt than us. What happened over the pandemic and the cost of living crisis was that we increased our debt by a greater share of GDP than the French did. So we've kind of closed the gap a little bit with France in terms of we're catching up to their dreadful level of debt burden that they're carrying. But the US has got a bit more debt than us on a net debt basis. Italy and obviously Japan both have dangerously high levels of debt by any sort of general assumption, economic assumption. But
that word dangerous is kind of interesting in this context. So because everyone did it and because everyone spent a lot of money during COVID, and most people won't argue that the money was, not needed at the time, and, things like the energy support was very important to people as well. Is it really something to worry about? Does it really matter that the debt pile proportionate to GDP is bigger than it was?
I mean, obviously the US debt is escalating far more rapidly than anywhere at the moment. You have to sort of take the Americans put them to one side, because obviously they have this sort of privilege, the dollar privilege. Everyone has to invest in their currency effectively. But there does come a point at which the markets are going to start to raise questions about the sustainability of your debt positions. Now, it does seem that Italy has the backing of the Eurozone, so that perhaps that is one reason why they don't. Not since the Eurozone debt crisis over a decade ago has it been really tested there. The other way of measuring whether it's dangerous, other than the markets saying we're just not going to buy it unless we charge and we receive enormous interest rates on the debt that we are going to buy, is to look at the sustainability of your public services in your own country. So just domestically, if the UK debt levels rise and the interest rate rises, you end up with less money available from the same pot of money. Less of that will be available for public services. So, for example, specifically, we've had effectively a £60 billion increase in our debt servicing costs since before the pandemic because of higher debt and because of higher interest rates. And that £60 billion is the same as what we spend on defence. But we aren't getting a bullet for that. So we're getting nothing for that 60 billion quid. That's why the fiscal position is domestically, if you just look domestically, is under so much strain.
So rates have been going up and up and up, making the debt servicing costs higher, but that's about to change, right? We're expecting rate cuts after the election. Does that mean that whoever is the next government can loosen the purse strings and actually spend a bit more on public services?
No, because interest rates were so low before, and they're not expected to fall. I mean, the bank won't tell us where it does believe rates will settle, but markets, etc., they sort of see it around 3.5%, 3.5%, maybe 4%. There's sort of technical aspects to the amount of debt and gilt we have and how much we pay on them and the inflation indexing. There's a bunch of different reasons why, although the interest rates are going to come down, compared with 2019, the projection under market interest rates from the most recent Office for Budget Responsibility forecast is we're still going to have between 50 and 60 billion pounds more a year. The cost of debt will be that much higher. So again, this problem of strains on the public finances as a result of the debt burden and the higher debt interest levels doesn't really go away. It seems to be a permanent fixture now.
So we've started with our debt mountain and we've come down to that kernel, £60 billion. That's the bottom line for the next government. That's the hole that they're looking at, kind of frittering away from their pot to spend from year to year. Our opinion columnist Marcus Ashworth has been writing as well about how the BOE could give the next government a bit of a leg up by slowing gilt sales at a loss, which is part of the deal of unwinding their pandemic era stimulus programs and ones that dated back before that as well. Does that seem likely that the BOE might be able to help out the next government?
So we did ask the bank this at the last press conference, whether they were going to stop this. Particularly, it's this active sales where they're selling gilts, so they're kind of competing with the government. They're selling the gilts that they'd previously bought. The government is selling gilts to the markets as well, trying to raise money for the country. So instead of selling them, they just let them mature. And so basically that would reduce the cost to the UK by about £10 billion a year. So that would give the government £10 billion more to spend, which would seem fiscally like a reasonable thing to do. Will they do it? As a betting man, I think it's going to happen. I think that there's fundamentally the Bank of England has a job which is to reduce interest rates. So they say that there's nothing to do with them, the fiscal position. But of course, if they're cutting interest rates, as you said, Lizzy, they're going to do, we expect, and you are tightening monetary conditions through what they're doing by selling these gilts, because it's kind of the opposite of cutting interest rates. There comes a point, and increasingly people in the markets are saying, hold on a second, this is contradictory. Why are they doing that? At the moment, the bank says it doesn't really matter. If one arm of the bank is tightening conditions, all we have to do is loosen conditions with the other arm, i.e. we cut rates even more, and you end up in the same place. So they say it doesn't really matter.
Just coming back to the comparisons against other countries, I mean, seen as if this seems to be a problem for everyone, can Labour really be pointing the finger at Liz Truss for the UK situation being as it is?
I mean, the more on premium was a temporary phenomenon. So that kind of extra premium where we paid on gilts for about 6 months after the mini budget fiasco, that has gone. I think you can't really pin the current situation on that little brief Truss tenure.
But the Conservatives have been in for 14 years. Can we blame it at least on the party?
Yeah, I mean, obviously, if you're the government, you have to take full responsibility for the consequences of your actions. I mean, there's no way they can wriggle out of this. I mean, there isn't any sense that Labour was saying, you guys need to do more austerity. Labour were not saying, you guys need to end furlough now because we're worried about the consequences of this. So, I mean, I think both parties kind of are culpable. In retrospect, but I don't think Labour they don't own the policy. It's the Tories who own that policy.
And it's difficult to say how anyone else would have handled either the pandemic or a war in Ukraine and what effects that would have had on the public finances as well. Decisions were made, but it's difficult to see, I suppose, what alternatives could have been made on top of that. Phil Aldrick, our senior economics reporter, thank you very much for joining us. Lizzy, look, that sets us up to understand at least perhaps why some of the parties aren't keen to announce big spending pledges. They've got a bit of a hangover problem to deal with when they arrive.
Yeah, but they don't just want to be vague on spending. It's also, we had the Shadow Home Secretary Yvette Cooper on the BBC over the weekend not wanting to put a number on how many migrants would be let in net. They've got this poll lead and they don't want to risk it.
That is a conversation for another day to tackle the issue of migration in this election campaign. That's it from us for today. If you like the programme, don't forget to subscribe. Give it 5 stars so other people can find it on Apple Podcasts, Spotify or wherever you listen.
This episode was produced by Tiwa Adebayo and our audio engineer was Sean Guastamakia. I'm Lizzy Burden.
And I'm Stephen Carroll. We'll be back with more tomorrow. This is Bloomberg.
Bloomberg UK Politics. Listen weekdays at noon on DAB Digital Radio in London.